So it's time again for another Federal Reserve balance sheet update. We're going to take a look at the quantitative tightening or QT program and see what effect it has had on the Federal Reserve's balance sheet. So as you can see by this chart that I pulled from the St. Louis Federal Reserve of the Fed's balance sheet, which you can look up for yourself if you want, the Fed officially announced the QT program in September of 2017 at the FOMC meeting on September 20th of 2017, and the quantitative tightening program, which was where it was going to start reducing its balance sheet by selling assets, in air quotes, either treasuries, letting them roll off, or selling mortgage-backed securities. That started shortly after that, a little under a month later in October, mid to late October of 2017. And around that time, the Federal Reserve's balance sheet was right under $4.5 trillion. And as of today, when I just checked the St. Louis Fed website, the Federal Reserve's balance sheet is just above $3.8 trillion. So just under $700 billion in a little under 2 years has been sold off in the QT program. The QT program is supposed to end as of now, I believe, in September. But there are people in the Fed who want it ended sooner. But the plan, I believe, as of now is for it to end in September. However, and this is the interesting part is this article that I just saw a couple days ago on July 6th from Wolf Richter via wolfstreet.com. And he said his article is called "Forget Rates, the Fed is Still Quantitative Tightening at a Record Pace." So I'll attach a link to the article, but I'll read some of it for you guys now. So where is the Fed's U-turn, in quotes, that Wall Street promised us? In June, the Fed shed Treasury securities at the slower pace announced in its new plan for quantitative tightening, or QT, but it dumped mortgage-backed securities, or MBS, at the fastest rate since the QE unwind started, breaching its quote up to end quote cap for the first time, which means they're dumping more mortgage-backed securities than they told us they would. So they cannot dump mortgage-backed securities tied to real estate fast enough. And it is experimenting with the opposite of its QE era, quote, Operation Twist, and then he says Operation Untwist. Total assets at the Fed fell by $34 billion in June as of the balance sheet for the week ended July 3rd, released Friday afternoon. This includes $15 billion in Treasury securities and a record $23 billion in mortgage-backed securities, for a total of $38 billion, less some other balance sheet activities unrelated to the QE unwind. This trimmed its total assets to just above $3.8 trillion at $3.813 trillion, the lowest since September 2013. Since the beginning of the, quote, balance sheet normalization, end quote, era, the Fed has shed a little under $700 billion at $648 billion. That's officially. Unofficially, we have no idea what they're doing off balance sheet with the currency swaps, any of that. So since peak QE in January of 2015, it has shed $687 billion. Okay, Treasury runoff. The Fed doesn't sell its Treasury holdings outright, but when securities mature, the U.S. Treasury Department pays them off, and the Fed then doesn't reinvest this money into new securities. Instead, it destroys this money in the reverse manner in which it created it during QE. But the Fed has announced caps, the up to, quote, up to amounts. If the amount of treasuries that mature in a given month exceed the cap, the Fed reinvests the overage in new treasuries. Under the Fed's new regime, the maximum amount of treasury securities allowed to roll off when they mature was $15 billion in June, and that's what happened. In June, 3 issues matured for a total of about $21 billion. The Treasury Department redeemed them and paid the Fed for them. The Fed reinvested $6 billion of this money into new treasuries, but allowed $15 billion to roll off without replacement. So the balance of treasuries dropped by $15 billion to $2.095 trillion, the lowest since September of 2013. And we know the Fed's going to have to reverse because the U.S. government is borrowing like crazy due to Trump's supply-side economics and the tax cuts. And federal government spending was not cut, so this supply-side economics is not going to permanently work. The last time it was done was Ronald Reagan's era, 30 years ago, when the debt to GDP was far lower. I believe the U.S. government's debt to GDP was 40%, and now it's way above that. So the U.S. government cannot afford higher interest rates to borrow. Excuse me. My throat's a little sore. The federal government cannot afford higher interest rates to borrow higher interest rates, and that's why the Federal Reserve, the central bank, is going to have to step in and try to manipulate interest rates lower with financial repression. Okay, continuing on with the article. Operation Untwist. Over the past couple of months, the Fed began replacing longer-term Treasury notes with short-term Treasury bills. It's the reverse of Operation Twist, which had been part of QE, layered between QE2 and QE3. During Operation Twist, it has replaced its short-term T-bills with longer-term T-notes and T-bonds in order to force down the recalcitrantly high long-term yields. Now it is starting to do the opposite, albeit in only small amounts. Short-term bills cropped up for the first time in its May-dated weekly balance sheet. In the current balance sheet, it lists $5 million, with the first batch maturing on July 9th, the second batch in August. The Fed seems to be testing what it said would be implemented after September, which is when QE2T is supposed to end, replacing long maturities with short-term bills to bring down the average maturity of its portfolio. If Operation Twist worked to bring down long-term yields during QE, doubts remain about that, then Operation Untwist should do the opposite and put upward pressure on long-term yields. So he's talking about steepening the yield curve, but as I've discussed at length in my Japanification video and elsewhere, the central banks need financial repression. They're heading towards Japan. They cannot afford high rates. So him talking about the Fed wanting to steepen the yield curve is wrong. Remember, in February, Lael Brainerd talked about the Fed wanted an inverted yield curve. They wanted to force rates lower, and that was before it actually happened, so she tipped her hand because she's trying to get a better job. So she was honest for a change. Okay, this is the real interesting part of the article for me. Mortgage-backed securities. So MBS securities differ from regular bonds. Holders receive pass-through principal payments as the underlying mortgages are either paid down through monthly mortgage payments or are paid off when the home is sold or the mortgage is refinanced. Any remaining principal is paid off at maturity. About 95% of the residential MBS on the Fed's balance sheet, they're issued and guaranteed by Fannie Mae, Freddie Mac, and Ginnie Mae, mature in over 10 years. So the current runoff is almost exclusively due to pass-through principal payments. So Wolf Richter, if you're not familiar with his work, if you're not familiar with his work at Wolf Street, he specializes in covering real estate markets. He covers those more than a lot of other global macro topics. He also did a really interesting interview with Chris Martinson of Peak Prosperity about 8 months ago. These pass-through principal payments vary with movements in mortgage interest rates. Falling mortgage rates induce homeowners to refinance their mortgages, which means that their old mortgages are paid off and their principals pass through to the holders of the MBS or mortgage-backed security. Mortgage rates had hit a multi-year high last November, and more as the Fed was hiking rates still, and I added that, and mortgage refi applications dropped to a decade low in December because interest rates were too high. But mortgage rates have since skittered lower and refi applications have surged, according to the Mortgage Bankers Association, probably because people are thinking that the interest rates are going to fall. And the flow of pass-through principal payments has surged too, and the Fed is taking advantage of it. In June, the balance of mortgage-backed securities fell by $23 billion to $1.533 trillion. This was not only the biggest runoff since the QE unwind started, but it also exceeded the $20 billion cap, another first. In other words, it had never happened before. So the Fed is dumping mortgage-backed securities, the toxic garbage, because the real estate market, they're probably thinking that the real estate market has topped, and they're worried because they see some of this data that we don't see. They see it first. They see the real estate data normally before we do, a lot of regular people. In May, the runoff for mortgage-backed security had hit the cap of $20 billion for the first time, but didn't exceed it. He has a nice chart here. The action of mortgage-backed security confirms that the Fed is eager to get rid of them as soon as possible. Its new plan calls for getting rid of all of them, all of the mortgage-backed securities, even if it had to sell them outright if pass-through principal payments slowed down too much, as it said. Starting late this year, it will begin to replace mortgage-backed securities with treasuries. And I told you why they have to buy treasuries, because the U.S. federal government cannot afford to pay higher interest rates. So the Fed has to come in with financial repression and be potentially the buyer of last resort, hence QE. Meanwhile, the Fed is making hay while the sun shines, given the surge in mortgage refinances and pass-through principal payments, and the prospect that when mortgage rates snap back, this flow of pass-through principal payments slows down. So I think that's enough for the article. There's a couple more things here. But basically, and I've been looking now, before I started this live stream, I was taking a look at some of the charts for some of the home builders, and they've had they crashed. The home builders crashed in September. The charts are ugly. So I'm looking at the Spider S&P Homebuilders ETF XHB, Xavier Hollis Bryan, and that chart, it's in a long-term downtrend really since January of 2018, and it's had some rallies, but then it crashed again on September 10th of 2018, and it looks like there was some falling knives that were bought in late October 2018 and December 17th of 2018, when the Homebuilders Index ETF was about to totally go like much lower than 31. The low point there was 31, which is also around the low point in 2016 as well, right around there. And it had not been that low since, let's see here, February 8th and October 6th. So this looks like a false manipulation rally, at least some manipulation rally. I know some hedge fund managers are shorting some of the home builders, but the charts are pretty similar to the home builders ETF, the individual home builders companies with the rally. There's been a very strong rally in home builders shares since December of 2018. There's been a couple times where there could have been big crashes, and then those were bought too. There's been some falling knives on the chart. Again, potential manipulation there. But if I was managing money, and this is not financial advice, I would consider buying out of the money puts on some of those home builders. Their charts just look like a fake rally. And with the Fed dumping mortgage-backed securities, they may have more information on how bad things are in the real estate market here in the US in different cities. Yeah, I'm doing another update. This is just going to be a quick one, a quick show. So there's a bunch of home builder stocks, and a lot of them have bad balance sheets. You have to keep in mind, though, with the home builders, that Congress changes the rules. So I believe it was 2009 or 10 that Congress, it could have been 2008, but I think it was 2009 or 10, Congress stepped in and changed the accounting rules, some of the accounting rules for the home builders, and they were given bailouts too. So they were given extra subsidies and bailouts and stuff like that, because since FDR's time, the U.S. government has been promoting home ownership as a staple of democracy. So in other news, we could have, before quantitative tightening ends, we could have a very weird combination of QT happening still, plus the Fed doing rate cuts. That would be very weird. And the other thing that I noticed, and this is another weird thing, is the divergence in the $2 indexes. So remember, I did about a month ago, I did a short little video showing you the $2 indexes. You have the regular dollar index, DXY, which everyone is familiar with, and then you have the trade-weighted dollar index, which the Fed puts out, which more measures the dollar against emerging market currencies on equally weighted. I think it's 26 currencies approximately. I talked about it at length though in the other short video. You could just look it up, a tale of $2 indexes diverging, if you want to see that video. Well, the dollar indexes they are diverging, but they seem to have switched and reversed. So the regular, let me pull up a chart really quick. The regular dollar index, when it was down at 96, is now rallying to 97.52. So after looking like it was going to correct, it's now rallying to 97.52. And the trade-weighted dollar index, which looked like it was going to break out, it was at 129 last month, and it was near an all-time high. It's now back down to 127.46, and the chart looking like it's starting to correct. So the two different dollar indexes seem to have switched. Markets, right? Because just when you think you have markets fully figured out, things flip. Oh, there's been enormous asset price inflation in real estate, and that's for two main reasons, guys. You have capital gains taxes on real estate at the federal level for the federal government, and then on top of that, you have property taxes at the state and municipal local level. There are big incentives to inflate the value in nominal terms of property, of real estate here in the United States. QT plus cuts. Why is it weird? Well, normally you would think the Fed, the dovish part of the Fed would be the rate cuts. And the Fed reducing its balance sheet is not dovish. That's why it's weird. So normally the Fed reducing its balance sheet would be hawkish, okay? The Fed raising interest rates would be hawkish. Fed raising interest rates, hawkish. Fed reducing balance sheet, hawkish. Fed cutting interest rates, dovish. Fed increasing balance sheet, dovish, okay? Hopefully I explained that simply. Gave you a couple I needed a couple seconds to think about that right. So you have cross signals here with the Fed where the QT program is hawkish and the rate cuts may be dovish. But with Japanification, as I said, it's creating big distortions. Japanification, when governments start doing financial repression, start doing central planning on the multi-trillion-dollar scale, tens of trillion-dollar scale, start manipulating interest rates, start distorting markets, you get stuff where the yield for Greek government debt is the same as U.S. Treasuries. You get negative yielding European junk bond debt for the private sector. You get a lot of weird distortions that only manipulation and government intervention can provide. The free market would never have a negative yield for European junk bond debt. Never. But those are traders probably gambling, speculating, or bankers speculating that they can buy this garbage up and flip it in the short term for a cheap profit to the European Central Bank. I don't know if Powell's going to end QT. We'll see. In all these short-term stuff, guys, I said, it doesn't matter. All the short-term stuff, it doesn't matter. Unless you're a short-term trader, it does not matter. Unless you're buying position sizes in the short term and trying to time the market perfectly, it doesn't matter. Okay, the Fed is trapped. The European Central Bank is trapped. The Bank of Japan is trapped. The People's Bank of China is trapped. All the major central banks are trapped. And I want to thank you very much for the $49.99 Super Chat donation from Yuri's Eclectic Extravaganza. Wow, that is a mouthful. E3, you got it, buddy. So, the Fed could be front-running the real estate market a crash. Could be. I would monitor this closely. And the Homebuilder stocks have had big rallies. Again, this is not financial advice, but it would look like an interesting trade here for me to do long straddles with puts and calls, betting on volatility or out of the money puts on the Homebuilders. And I already mentioned the Homebuilders ETF. If you don't want to pick out an individual company, if you want to do the research and go look at the balance sheet, the financial statements and balance sheets of these Homebuilders, you could figure out which ones have the worst balance sheets. And those ones would probably be in the most trouble. So, interesting times, right? So the Fed is dumping mortgage-backed securities a lot more than they said they would, and at a faster and faster rate. And they're planning on trying to get rid of all of their mortgage-backed securities as soon as possible. I guess this is just part of the new normal. You'd think that they would have already, during the real estate rally, been able to sell a lot of their mortgage-backed securities. I know they were able to help engineer like these private equity funds like BlackRock and hedge funds buying up entire like rows of houses or developments in like Las Vegas and elsewhere. I know they did that within a couple years after the 2008 financial crisis. You'd think that they would have dumped the mortgage-backed securities sooner than that. But, I mean, the people at the Fed they're book smart and common sense stupid. Let's just say that. They're very book smart and common sense stupid. A lot of them don't have much common sense. Well, actually, maybe off the record they would. But, you know, with the policy decisions they have with their Keynesian ideology and how they have to bail out the U.S. federal government for spending, they're trapped. Okay, so thank you very much for the other Super Chat donation. Wow, I made a lot of money today for this short little video. Chris Hamilton, thank you very much for the Super Chat. It's much appreciated. I have to get my website a couple there's some bugs on my website. I have to get a couple things fixed, and then I've gotten a bunch of emails for the email capture program. It's the plugin's not working. I have to contact a developer and get that stuff fixed. Same thing with the Bitcoin donations. I do have the emails. I have to get that stuff done. I've just been busy putting out good content. So maybe I can work on getting Wolf Richter on to talk about this for an interview. I have reached out to him in the past, sent him emails and stuff, but he hasn't responded. My channel is big enough to get guests like him. It's weird. Oh well. Well, that's enough for right now. And I'll see you guys later. I think I covered pretty much everything. And if you want to read this article again from Wolf Richter, I read it all to you guys. But if you want to see his charts, which are very interesting, I'll attach a link in the information section. And I'll also put his interview with Chris Martenson at the end of the video. Okay, bye for now.